Okay, so we're going to get started here on stablecoins. Remember, stablecoins here in English, look back, system validations on the other side in Spanish. So you all may remember, and Pam wasn't here, we had a lively discussion about crypto and stablecoins yesterday. In fact, there was one statement made that created a little furor with me, that law enforcement loves crypto. Now, the reference to that was obviously traceability, things like that.
Sure.
But then there was talking about how stablecoins are a great product for money launderers. How about that one? So that's kind of the context that this audience heard yesterday.
Sure.
So it'll be interesting to hear your take. You know, both sides, obviously, the risks and benefits. The benefits were discussed, but those statements kind of stood out. So, Pam, thank you for doing this. Really appreciate it.
Well, you know, it's great to be here. I will say, in that same vein, David and I were talking about preparing for the conference, and I said, David, every time that I am speaking to a bank, I hear the word stablecoin at least 20 to 25 times. So I feel like we need to break this out apart from crypto and really have a discussion about what we're seeing with stablecoins, what are the use cases within the banking sector, within TradFi, traditional finance, and what is the actual technology and what's happening with regard to privacy, right? You guys talked yesterday, obviously, about why law enforcement loves crypto, and it's, you know, everybody thinks of the traceability that the blockchain provides. But what does that actually mean for real use cases when we talk about banks? Banks their customers don't want everyone to see all of their activity and how that's being used institutionally. So we're going to talk about that. So I brought some amazing experts to talk about this today on the panel. And this is going to be a very genuine discussion. They will say, you know, they'll be fairly frank about everything. So we will have real live discussions and maybe even a little bit of debate. But before we get started, and even before we even do introductions, I would like to know, just by a show of hands, how many of your institutions out there are talking about stablecoins or already looking at stablecoins in a real way? Raise hands, even if you're just talking about it. Okay, so quite a few.
Handful.
All right. And then raise your hand if that is being driven from outside of your institution, like by clients. Is that being driven from clients or consumer demand? Okay, so it's being driven from inside the institution. Yep. So we generally see that. I've had multiple conversations, board of directors. So even from the board of director level down, and then of course the business units, right? So then that just kind of leaves the compliance and AML guys kind of just hanging out, trying to figure out what we're going to do. So we're going to talk about all of this today. My name is Pamela Clegg. I'm the head of growth strategy at Inca Digital. We provide ecosystem intelligence within the digital asset space. We work with a lot of stablecoin issuers and a lot of traditional financial institutions. I've been in the space for 10 years, within crypto specifically, and then spent over a decade with the government before that. And I'm joined today by, I'll let Yaya Fanusi go first. Welcome, Yaya.
Thank you, Pamela. Yaya Fanusi. I am currently Global Head of Policy for the Alio Network Foundation, and it's a sort of unique institution to be up here because Alio itself is a cryptocurrency blockchain. It's a private blockchain, and the foundation oversees the ecosystem, and we'll talk a little bit about that because it's a privacy-focused blockchain. But before that, like Pamela, I think for the past 10 years, I've been involved in crypto, really as a researcher looking at illicit finance and US national security issues around crypto, doing a lot of research over the years on terrorist financing in crypto, sanctions evasions in crypto, the development of CBDCs and all types of digital assets. And before that, I also worked for the US government for several years in the national security space on counterterrorism and economic issues, and happy to be here.
Great, thanks. And then we have Carol. Hi, Carol.
Hi,
Thank you for joining us.
I'm excited to be here.
Good, we're happy to have you. Would you like to give a brief background introduction?
Sure. So I'm currently the co-founder of Threshold Partners, and we consult to banks and financial institutions and fintechs that want to be in banks on stablecoins and crypto matters. We'll get into it, but there's so much noise out there. Prior to this, I was global head of business development for a firm called Tacit, and Tacit built and operated Signature Bank's Signet platform, which was the instant settlement network that they deployed and Customers Bank used as well. And I don't need to go further back than that, but I have worn many hats. I was a financial institutions group investment banker. I did asset liability management consulting for banks. So I've been around for a long time. I'm not going to assign years to it, because then we'd get into decades.
Thank you. All right, thanks, guys. So just to set the stage, I'm just going to give a really brief definition of what a stablecoin is. I think we're all on the same page, but we'll just give the short version of a stablecoin definition. As we go throughout our discussion today, you're going to see that that really has various different nuances to it, and stablecoins are really taking on so many different roles and use cases. But technically, a stablecoin is a digital asset designed to maintain a stable value, right? So typically pegged to a fiat currency, one-to-one to fiat currency. The ones that we often hear about the most, right? Tether, USDC, those guys, those are pegged to US dollar, one-to-one. So there is technically or supposedly or allegedly a reserve to back that one-to-one. So that's why you will see the fluctuation in the actual market capitalization that you have within each stablecoin, because their reserves are actually fluctuating depending on how those reserves are being held or invested. And then you can also have stablecoins, just to cover all bases, that are pegged to a commodity or a basket of assets. But I think for today's discussion and what we see obviously most of the time right now within TradFi and fintechs, we're talking about stablecoins pegged to fiat, right? So that's really where our conversation is going to center. So we see a lot of different use cases, and I think we'll cover a lot of these, but we've got everything from cross-border payments to treasury management to exchange liquidity, merchant settlement, right? That is happening more and more. The industry is really kind of getting a little cloudy sometimes with who's doing what and how they're doing it. And then we also have various different types of integration that we see at the banks, to include partner models, non-custodial approaches, possibly even banks issuing their own stable coins. Carol has an opinion on that. So there's all kinds of different use cases. And so let's just go ahead and jump in from the top. I want to go over why we are seeing all of this activity right now, because it's a busy year. This has been a busy year for stablecoins.
It's been busy. In 2026, you can't talk about what's happening now without talking about what happened last year with the Genius Act. Can I jump into that?
In.
So a lot of people are like, okay, we've heard the Genius Act, but before we explain what the Genius Act is at a high level, I want to explain some context, because we've been following crypto for over a decade or so, and I'd say for 6 or 7 years, whenever you talked about crypto in conferences, people would always say, oh, this stuff sounds interesting, but it's not really adopted, it's not mainstream, and the term people used to always say is, crypto doesn't have its killer app yet. It's like, oh, it's just people speculating, but what is it really used for, for an everyday person? And slowly what happened within the past 4 or 5 years is the killer app just became very apparent. The killer app became stablecoins, because stablecoins, as Pam said, are pegged to or backed by an asset to maintain a price. So what happened in the crypto space, and then people outside of crypto, they started to see, wait a second, I've got price volatility, I've got inflation. Why don't I just buy some of this USDC or this USDT, and then it keeps its value? So you had that, especially outside of outside of the United States. You had people who realized, well, you know what? Oh, you mean I can just buy this token, and then I can do an international transaction, international trade, and instead of going through the banks, You're going to accept a Tether, you're going to accept a USDC. Why don't I do that? And then I don't have to pay these bank fees and foreign exchange if you'll accept the stablecoin. So slowly but surely, stablecoins became a very usable item. So what happened in 2025 is in the US, Congress passed the Genius Act. And at a high level, the Genius Act is a comprehensive framework for regulating stablecoins and specifically payment stablecoins in the United States. So it offers standards around reserve requirements, like we said, like what is it backed by, auditing, consumer protection at a very high level, anti-money laundering, AML, CFT, and sanctions requirements. All of that is laid out in Genius. In 2025, it was passed. It's now law. So now everyone has gotten the message that, oh, so this isn't just something that's happening on the side. You mean as a bank, I could potentially use stablecoins for interbank settlement? It's in the law. It actually says that. And that's why I think we're seeing this rush for people to figure out how to get involved in stablecoins.
I think it also, we were talking just before we came on stage, it also has to do with what the market is looking like for banks right now. And I'm speaking in particular with regard to like the competitive landscape for payment rails. So Carol, like what does it look like right now for bank? I mean, Stripe. There's an elephant in every room, in every bank conversation. That Stripe is out there. We've already seen that, I hearken back to just even, you kind of saw this coming, a little bit of foreboding with like just the Venmos and the Cash App. In Brazil, it's a little different. They've got Pix, and that's run by the central bank. So they kind of went ahead and just stepped in and went ahead and built something that is, really kind of government oversight and has integration into all of the different sectors there. But what does it look like right now in the United States?
Well, as I mentioned before, it's super noisy, so banks really don't know what to do next. And when they look at what the possible use cases are, if you think about it, JP Morgan has 80% of commercial payments. So the cross-border activity, and Citibank also did their own study, same thing. That's the use case that a bank, that's relevant for a bank. The problem is it's only relevant for like 20 banks, because none of the other banks are really doing cross-border settlement or that kind of business, or the volume of commercial payments. It sits with the larger banks. But they're quite anxious to stay in the game and be relevant. So what does that mean? And when you mentioned the payment piece of it, payments are going to be really where stablecoins come in. And you see some non-bank issuers, like Walmart's going to have a stablecoin. PayPal has one with Paxos. I would assume Starbucks will have one. All of those entities, it makes so much sense because it will really smooth out all of their transactions with their customers by using them. What a bank probably needs to think about in that arena in the payments is accepting the stable coins, not so much issuing their own and expecting it to be outward facing, but really be a service provider to those who have them. Stripe is a company that I have watched really closely for a long time. They bought Bridge for over $1 billion. Bridge was 18 months old. I think they had fewer than 25 employees. They did not have a use case that was anywhere. I managed to get Tacit in there too late. But they have been on just running like crazy to capture the payments space, and they have done so. So in terms of services for a bank, it's really how do you want to interact with the payment providers, because you're not going to be one. And Visa and MasterCard also have their own strategies. They have never believed that they should be issued through a bank, and now they don't have to be. They're being trained by Circle and Coinbase and Anchorage and everybody else that you can do these transactions without a bank sitting in the middle of it. So a bank does need to think about how they're going to be competitive and how they fit in the payment landscape, or they're only going to own half the balance sheet, and that's the one that is risk-based. Oops.
Ding,
Risk-based.
ding.
Risk-based. So let's talk about that real quick. So you mentioned already Tacit, right? You help build real-time payment network. How do stable rails compare to what we traditionally kind of know as, or what we've known, whether it's from Silvergate or what customers has right now?
Yeah.
What do we already have, or even FedNow, right? How do stable rails, and lots of people will shorten them and call them stables instead of stable coins. I'll do that throughout the conversation. So stables, how did those payment rails compare to what we already see right now?
So the history of stablecoins, or this instant settlement within banks, is pretty interesting. And the use case for them really came down to servicing the crypto community, because they needed that instant settlement, and the blockchain could provide it with known actors on either side and the assurance of the guarantee of the settlement. Silvergate Bank was the first one to invent the send system, and it was only designed to operate within that bank. They did not use blockchain. They were cloud-based, and a great service, but it was not interoperable between banks. Signature Bank came to Tacit and said, we want that, and can you build that for us? And so the team at Tacit built, based on blockchain, different, and with the goal of getting a consortium or interoperability between banks. And we did transact $504 million on a Saturday between 3 banks, with all of the regulators and their hairy eyeballs staring at us without any issue. But the fact is that there was no use case beyond serving crypto customers who wanted to settle in fiat, whether it was between themselves or with a third party who's also in the space. I will tell you, though, the volume on Tacit, half of it was treasury management, at least. So we would see a crypto exchange, I won't name one, but they might have 15 DDA accounts, and 10 of them were attached to wallets. And we would see movement between those wallets. So I don't know, but the underlying, I would presume, the underlying assignment of those accounts could be digital exchange clients sitting in India, digital exchange clients sitting in Ireland, digital exchange clients sitting in New York or the US, and settling between those entities as a treasury management tool. And that was really where a lot of the corporations were seeing the blockchain use case too. I met with a very, very large insurance company thinking that they would want to do a settlement process on collecting premiums and paying out claims. I didn't get 2 minutes into that conversation when the CFO was like, no, I need to manage my treasury. That's why you're here. So that was really a big thing. And when I talk about the volume that ran on Tacit, in the time that I was there, which was 3+ years, we transacted almost $3 trillion in volume with 2 banks active. So there are demand signals out there for sure. But it was that single use case. There were some other ones around, a shipping company and some other use cases that were kind of interesting, maritime finance, but none of them caught fire like serving the crypto community.
So, I mean, that's treasury management. We're talking about
institutional. Oh, how do they differ? Let me get back to that. Okay, sorry. So the big difference is SEN, not interoperable. Tacit was interoperable. Okay. And stablecoins, if that becomes ubiquitous, that is interoperable, or should be. And it won't run the same way as those 2 products did, but it will serve the same function.
Got it. So, Yaya, talk about what Aleo is building, and include the part about interoperability, because as we've just clearly laid out, you've got Walmart, you've got Starbucks, they are going to be issuing their own stablecoin. Institutions are going to have a way to accept those payments, right? So what is Aleo building? How does this compare? Why do we need privacy? I mean, we just talked about moving $3 trillion. I don't know that really needs to be, anyway. So let's dive into that.
Well, let's go back to our old blockchain 101. Everyone in this room has gotten some briefing by someone to explain what Bitcoin is, what blockchain is. Many of you have probably been in those briefings or been on those webinars. And let's go from what you first learned, which they would always say, you know, the blockchain is, one of the things is it's transparent, it's public. You can see the transactions. A lot of times on this stage, people have been talking about tracing, how law enforcement uses that. Some people say, oh, law enforcement loves crypto because they can trace it, et cetera, et cetera. Well, that is a feature, not a bug of the blockchain. And for the past, 10, 15 years, this has been an issue for crypto enthusiasts where their wallets are public, but it hasn't been a mainstream issue because most people aren't accepting or using crypto, right? So who cares that you can see your Bitcoin or whatever? It's a very niche concern. But the challenge comes now if and when financial institutions are planning to enable a wide mass usage of stablecoins. This transparency is something that now needs another look. Because what it means from the individual, first let's say for the individual, it means if someone is using a stablecoins and they're using it for payments, everyday payments, because of that transparency of the blockchain, because it's public, it means that now it's very easy to identify your wallet, track you, see what's in your wallet, to learn your transactions, because once I know your wallet address, I can track it publicly. I just go on the internet, on the browser, and look at your transactions for all time. That is a new situation that most consumers, that all consumers, right, are not, wouldn't put up with. So there's a problem now, and this gets into what Alio is building, because we started to see that a lot of the stablecoin issuers have not solved for this problem. If you're issuing a stablecoin and it's public, it's functional, right? It's efficient, 24/7, all of those things. But what about the privacy? What about the fact that now if someone figures it out that that's your wallet, then that could be a security risk. So what we've been doing is integrating, building infrastructure. We're now a stablecoin issuer, like a Circle. In fact, we have this with Circle. They can create a solution so that now those stablecoins can be pegged to another stablecoin that has privacy features. And now users can use that. And that's just a sort of generally.
We might get our first debate here.
Oh yeah, listen, this is, all right. So I'll just drop that there in that I'll end with, I said what the problem is, transparency, right? Solution, now the crypto space and these stablecoin issuers have to figure out how are they going to solve for the exposure of the blockchain, and that's what many people are trying to build solutions for. Let's go.
Which is super interesting because Tacit was built on Ethereum, a private permission blockchain.
You did a private version.
Private permission.
Private, yeah.
So none of that was public. And in fact, we offered every bank to give the regulators a node. So regulators could look at everything.
Right.
Very little, so appetite for the accounts for sure. They did not want the regulators to have the node. That's fine. But firms like BlackRock, Fidelity, Franklin, the three largest asset managers that are in this space, they do not believe private permissioned has the legs. They want open blockchain.
Because it limits interoperability, right?
Yeah.
We just said that if Walmart issues a stable coin, right, and then I want to put that into my bank, if it's private permit, now my bank has to already have been permissioned into that, right, to be able to get in. So it does bring up, obviously we're at an AML conference, right?
Yes.
So it does bring up the question of, as we add layers of privacy, and just to clarify, what Yaya's talking about too is, let's say stablecoins are becoming the payment norm, right? I go into Starbucks and I buy my coffee, right, with Starbucks stablecoin. Starbucks now knows my wallet address, right? So they could... The barista knows my wallet address. They could sit on my wallet and know exactly how much, right, funds, how much I have in funds, whatever it is. They could look at all my past transactions. All of that is transparent, which is why there was the debate yesterday. Why does law enforcement love crypto, right?
They can already see all your transactions because you're doing it through the app.
Of course, exactly. Depending on the level of access, maybe not necessarily the barista, but yes, whoever has access to that app can see it. But the barista could then pass that to their friend who's not in Starbucks,
But they also
Right.
can't see, even though Starbucks or any merchant knows what you bought,
Yeah.
they don't know what
What
you're
I
buying
bought
next
somewhere else,
with
yeah.
another merchant. They can't look
Exactly.
at your bank account
Yeah.
and see, oh, you've got
Yeah.
$1 million or you've got $1,000. They can't.
I think that those companies are going to be using stablecoins really for more of the merchant-to-merchant activity, inventory management, treasury management, smoothing out that.
Sure.
When they've got subsidiaries, smoothing out the transactions between that. One example could be a bank like Zion's Bank has 7 subsidiary banks, and until recently they operated completely separately. They did redo their core, so now they have one. But if I wrote a check from Amegy Bank, which they own, to you, and you've got accounts at Zion's, and you have accounts at Torrey Pines Bank, it would have to go through the Fed to clear.
Exactly.
Because they were separately chartered banks and run that way. So that a stablecoin would really smooth all of that out within a bank, the same way the treasury management system works for the corporations.
So let me raise a question. I want to hear your thoughts on this because you're right. We were just talking about the personal, Sally Mae at Starbucks, right? That's one person.
If they didn't invent that pistachio latte, I would have so much more money, you guys.
But here's another, and this is a question. I'm not saying I fully have a fully fleshed out thought on this. But let's say just for the institutional back-end use case, remember, we have to think like the bad guys.
Yeah.
Whether they're sanctions evaders or whether they're people doing, even just your competitive adversaries. So here's my concern about even this institutional back-end settlement stuff. If you are going to use a public chain, which is open, it's not going to be very difficult for some outsider. Now, you're right, like an outsider can find out, oh, how did such and such bank do that settlement? Sure. And now that person can now look at the bank's holdings in stablecoins. Yeah. They can look at their positions. I mean, whether it's a bank or some other financial institution, now it's going to be easy to do things like front running, identifying, like just basically just analyzing the movements between institutions. Yep. It's not individuals, but now maybe if I'm an unscrupulous person, I can figure out, oh, I know what they're doing because I can see it all on the blockchain.
Actually, I'm going to go deeper on that one with you. So the tokenization of securities.
Yep.
Not quite a stable coin anymore, but BlackRock has announced they're going to tokenize everything. I know that's what Mike Cagney's working on at Figure, is tokenizing everything. So imagine I'm a bond trader, and I'm trying to sell something. But the other side can look at what I paid for it.
Yes, absolutely.
So they know I'm making 15% on it.
They know what your markup
is. And they decide,
is.
no. That's too rich. I'm going to offer her 7%. She's only had it for 6 months. Yeah. That's ridiculous.
Yeah.
So suddenly you have a more informed universe of financial transactions because there's nothing that can't be known if it's on blockchain.
And so what is it, before I give back to, I just wanted to bring it to the banks, to the financial institutions, because we talk a lot about the AML side of things, but what I've been thinking a lot about is GLBA, right? Graham-Leach-Bliley Act. The GBLA, which makes it clear that as a financial institution, you have to protect the consumer information, right? Non-public information. Now, generally, the old way of talking about stablecoins was, well, it's public, but there's no identity, right? There's no, it doesn't say, Yaya Fanusi or whatever. It doesn't say that, and people would say, well, that's public information, but there's a complication if now my customer's information it can be easily attributed, their name, their wallet. So are there going to be now regulatory issues about if you're providing stable coins to your clients, and is it public information or is it private? And is there now maybe going to be a burden where you need to offer them a privacy solution? Because here's a scenario that I'm pretty sure will happen. Joe Blow, user of stablecoins. For some reason, they're using the stablecoin issued by your financial institution or your institution, and someone does what we were saying. They track the person, they do social engineering, or they just watch their wallets. They see, oh, this person has, $100,000 worth in stablecoins. I'm going to go to them, I'm going to rob them, I'm going to kidnap them. A bad thing happens. How long before one victim says, financial institution, I know this is a stablecoin, but you just sort of allowed this and this person tracked it. I went through your system to use stablecoins and I got robbed and kidnapped. I'm going after you. And that's when, if a scenario like that happens, people are going to think about, can we just enable everything to be transparent if we're going to have adoption of these assets?
Well, and that's if it's, are you saying if the bank issues the stablecoin or if they're accepting it and using it?
So I'm saying if I'm the victim, I'm going to go after
Everybody.
I'm going to see, where did I get the stablecoin from? Who had sort of control of the process that allowed me to get? Maybe I go after the issuer. But again, it depends on how all of this shapes up. If you're going to get involved as a financial institution, you do have to think about these risks. If something goes wrong due to the transparency, where does the privacy come in? And I'll sort of end this thought on this because I've been following crypto and illicit finance for a long time, and the privacy conversation for most of us has always been mixers bad. Mixers, the bad guys are using mixers and mixers, and we hate mixers. And the crypto space has always been saying, well, there are real, legitimate uses, and then everyone says, no, nobody cares about that. You crypto folks are on the fringe. What's happening now in Washington, and I even think in the private sector, is now privacy and privacy preservation or privacy preserving tools are being mainstreamed. Treasury just put out a report a couple weeks ago on innovative methods or innovative technologies for illicit finance or discovering illicit finance with digital assets. That report by Treasury, where are the Treasury folks that were here? The report says there are legitimate uses of mixers. Now, of course, we want to go after bad uses of mixers, and we don't want, we want to look at the risks, obviously. But I'm just saying that things are changing where it's not so black and white, privacy preservation is bad. Now we're going to have to think about, do we actually maybe need some privacy preservation tools if we're going to start using blockchain-based assets?
Well,
I think it's obvious that we do. I think there are other tools banks need to have, though.
There's a lot of tools that banks need to have, yes, and I think there's a lot of ecosystem intelligence that we can bring in. So it's not just what's happening on chain. So what is happening on chain is transactional level. Right, and I think with traditional transactions, we don't just look at that actual transaction, right? We, as a financial institution within the TradFi space, we take a step back. We look at the customer, we look at the customer profile, we look at the expected activity of that customer. We look at what's happening, adverse media, negative news, right? All of that's brought in the TradFi space. That also has to be applied with the use case here, right? When we're talking about stables or if we're talking about crypto in general. And that's what we're looking at. So I have a question here in the questions that are coming in. There's a lot of good questions. Send them to me, English or Spanish, doesn't matter. One of the questions, and this kind of also goes to a question I had for you, Yaya, which the question is, do Stripe or stablecoins, et cetera, make the identification of beneficial ownership more difficult? And then that kind of builds on the question that I was going to ask you, which is, how can institutions balance user privacy with obligations like AML and sanction screening and transaction monitoring?
So I think two questions. The beneficial ownership question, that is a good one. And maybe I'll save that for last.
Because it puts an intermediary, right? Like it's a good, we've been talking about a lot of, the need for counterparty risk, guys, that intermediary, that's the problem with just looking at on-chain.
Absolutely.
Right, that's where you get into the issue. So if you just have a blockchain analytics tool, that's not going to cut it, right? You've got to get into those additional layers that comes in.
And I think this is why what you're saying is so key. Yesterday on this stage, I think it was yesterday, maybe the day before, there was a panelist. I think it was I hope I can mention their name. They said it publicly. It was Tower Bank, right? Tower Bank International. And they said on the stage, they said how they have to assess any random coin that comes up, they need to assess, like, is this a bad coin? Like, if it's a DeFi stable coin, et cetera. And that brings in what you were saying, which is basically what they said is, well, we look at how is this being used. So the good thing about all of this technology, is that now you can take the on-chain stuff. You hear some new token that a customer is using or we see in the ecosystem. Now they can do research and explore the ecosystem where they find out, well, what are indications that maybe this is being used? Is it being used on the dark net? Is it being used in this situation? What country is it coming from? These are all the ecosystem indicators that you would have to look at as an institution to then decide, okay, yeah, this is probably a bad thing. Not just that you saw it on the blockchain, but all this other information that you gave.
Who's holding it? What does that distribution look like?
Banks should be able to control what stablecoins they interact with.
Absolutely. Yes.
So, and I would predict that there's only going to be a handful. I don't think it's going to be like a foreign currency thing where there's 80 of them, right?
Yeah.
I think a bank is going to choose 10 to 15,
Probably.
10 to 20.
But even for those 10 to 15, they need to understand what does the ecosystem risk look
Sure.
like at any given moment
And yeah,
for
it could
that,
change.
for those 10 to 15 stable coins that you're choosing to accept at your institution. Why? Because there may be a depegging event happening somewhere, which
Right.
means that you may have a run on that particular stable coin. Or there may be something, there may have been an exploit, and now North Korea just got its hands on a significant portion of that stablecoin's liquidity. Or, so there's a myriad of different use cases. Or that stablecoin is being promoted on some forum that, hey, this is the one you need to use if you're going to do XYZ illicit activity, right? So there's a host of other intelligence that
Sure.
needs to come in
Well, and that's
go into
what-
those
that's
assessments,
where Inca
right?
comes in, right?
That's what Inca does. Selfless.
There we go.
Yes, very, very, very
No,
nice setup for a plug, but that's what Inca does.
And the firm I'm going to mention now isn't the only one out there, but it's one I know pretty well. It's called Stablecore. And Stablecore is an interface. It's the middleware a bank would use to interact with stablecoin providers or people that want to pay in stablecoins and then enter into a banking situation. And it's a very elegant dashboard that provides that transaction
For that.
facilitation.
So Yaya, who applies actual controls?
Very good.
Do you
Good question.
guys apply controls? Obviously, the banks have to apply controls.
So-
The intermediaries. Who's applying controls and how?
So this is where I have to say, the stuff we're talking about now, at least what you just asked me and how I'm going to respond, we're talking about cutting edge. This is there aren't even white papers written about this yet. In fact, I'm working on it. When I get back to my hotel room, that's what I actually am going to be working on. A white paper that explains how can a private stablecoin or privacy preserving architecture in stablecoins work? What are the controls? Nobody has written, this is not out there yet. So you all are reading, you're getting the cutting edge. I'll share one thing, and with the caveat that this is version 1. There are building blocks. There are lots of different models for how you can do privacy and then have risk mitigation because of the AML concerns. I'm not saying this is the whole suite of everything, but one of the models that's out there that's being worked on is a model where you take a token is created backed by a stable coin, and now all these types of stablecoin assets can have private, confidential transactions, but what's also built in is a view key. And the view key can be used by the issuer of this token to look at the transaction so that even though it's private from the public ledger, any observer just can't look and browse and see, there is someone that has responsibility to look at the transactions, do transaction monitoring in even the private ecosystem, and also you can build in controls like a freeze list. And the freeze list could be linked to OFAC, it could be linked to other, you can build it. And when I speak for Alio, Alio is not a issuer, right? Alio is just a blockchain. And what we just encourage is that, hey, people can build, and because of the programmability of the blockchain, you can build certain controls. You can build the parameters for what allows a person to transact. This is one model. And I'm not even saying that this is the end all. If we talk about, well, what are, what are the other developments? How can people try to exploit? You basically have to build the compliance program on top of this. So this is where we are. So AML, can be built even on top of these sort of permissionless blockchains. This is where I think the standards are going to have to come. And industry and regulators, this is a conference for next year, a topic where we discuss how do you build in programmable compliance? How do you build in controls using smart contracts? That's the next conversation that you're going to be hearing from in the coming years.
So yeah, we did have a question that says, and it kind of to that effect, when you identify a payment that came from a sanctioned wallet address, the audience member says that they understand that it's not possible to reject that or return that payment. So how do you actually approach a case in that situation? And I think in that case, it really depends on the blockchain,
Yeah, you
and it
can block
depends
it.
on the stablecoin. Yeah, go ahead.
You can block a transaction before it happens, for sure.
And so there's also, so it's, first of all, the issuer, in most of these centralized stable coins, the issuer has blocking and freezing capacity, and that's actually something that is ingenious and is being worked out in legislation now, that an issuer has to be able to freeze, to block. For you to be authorized by Genius, as an issuer, you're gonna have to do that. And then of course you have the exchanges, right, which are regulated institutions, which also, once they see that, oh, that's a list, that's an address that needs to be blocked, they themselves can block it as well.
Yeah, you can do other things too. You can set transaction size parameters. You can, there's a lot of ways to build, and you mentioned smart contracts, that's something we did at Tacit a lot. You can build a lot of safety pieces, that anything you can really imagine, to control the activity at your bank. And I think when you bring it back to the bank, you need to decide, are you serving your internal functions? Are you serving corporate clients? Are you going to get into the payment space?
Yeah.
All of those are very separate, very different from risk management, privacy management, regulatory answers, KYC, all of that. So strategically figure out where you fit as a bank in the ecosystem if you choose to do it. I will say, if you choose not to do it, you probably won't be around very much longer, in my opinion. There are 5,000 banks in the United States. Most of them have boards of directors in their 60s and 70s, and some even in their 80s. During the financial crisis in 08-09, they had to stick around because they were in a crisis. Then they stuck around too long and COVID hit. Now their banks actually really needed the multi-generational experience to keep it all together. And now they're at the point they're saying, please God, don't make me learn something new. And this is something really new.
Something really new. So for that, to address that issue, in your experience, what is the lowest risk entry point for a bank or for usage we're getting into stables?
So a couple things about that. One, if you don't have your technology teams playing in the sandbox in this space, you are losing ground every day. You have to have people and enable them, and you were forbidden from doing it as a bank until Genius Act. So this is all very new. But you need to have internal experts that you are developing, because nobody did it before. So internal experts that you are developing, you're giving them sort of not even a roadmap, but permission to go figure it out. That is the number one thing a bank needs to do.
You can call Carol.
Yeah, you can call me. That's what Threshold does.
Yeah.
Better call Carol.
But someone on your team and in your IT stack has to understand all of this to help make decisions.
Yeah.
Have an idea what your use case is. When I was consulting with Stablecore, the first thing they said was Bitcoin lending. And I'm such a Girl Scout. I was like, oh God, don't say that to a bank. That's crazy.
Yeah, don't say the B word.
That's insane.
Don't say the B word.
Nobody would do that. And after being in 50 meetings with those guys, 70% of the banks brought it up.
Yeah.
We want to do it. I don't think they want to do it now, that it's been cut in half. But there is a notion that they want to be competitive and retain the client assets, and they believe that they can write underwriting that manages the risk of a Bitcoin, which is crypto, which is completely separate from stablecoins. And if that's the number one thing you leave here with today, a stablecoin is not the same as crypto.
No.
At all.
It's a misnomer. It's a coin. None of them are coins. They're actually tokens.
No, and that's too bad too.
That's too bad.
I got in a huge fight with a chief investment officer. He's like, it's not money. And I'm like, no, they could have called it lipstick or shoes. That's too bad they called it coins.
And I think too, it's really important, since we do have an international audience here. I think one of the things that's important to point out is that with Genius Act coming into effect here, it really, in talking through, I cover also to Latin America region, talking to banks in the region, they finally feel that they are able to really engage in the space as well, because now they won't put at risk their correspondent relationship with their U.S. bank, right? Because their U.S. bank is now looking to do something with stablecoins also. So it really kind of trickles down throughout, the really other regions in the world, that once kind of we had some pathway here in the United States, then they really felt like, okay, well, if they're going to allow banks in the United States to do it, now we feel like we can also more safely, aside from some of the outliers, right? Tower Bank has been in the space for years.
There are a very specific group of banks that have been looking at doing this and doing it for some time.
Yeah.
But that number is less than 50 out of 5,000, for sure, that are really agile and facile about it and have the expertise.
And the foreign, the international side of it is going to be very important. No matter where you are as a bank based outside the United States, you have to understand Genius, because what Genius allows is there is a pathway for foreign issued stable coins to also operate in the United States. So there's a question of, should your bank be getting involved in this, and how would it be managed here in the United, or how would it be seen? How would that stable coin be seen? But even if you don't do that, because now U.S. banks are going to be looking for ways to use stablecoins, so the question may rise up where if you have a corresponding relationship, if you're dealing with a U.S. bank that has a stablecoin, how can you interact with it?
Yeah. Actually, if there's non-banks here, I would assume, if you go to a bank with an actual use case, that is the most important thing you could bring them as a client. If you're a client and want to use them, have figured out how it's going to work, go talk to your bank. They're trying to figure it out too.
Yeah, and the Genius Act point, that's a really great point. So Inca provided, it's all public knowledge, but we built the back end, the compliance program for a government-issued sovereign debt-backed stablecoin out of the Marshall Islands. It's not technically it doesn't technically fall within Genius Act, but we still built it to Genius Act standards, right? Because who knows where we're going one day. And the reason why it's foreign issued, but also too because it is a yield-bearing stablecoin. It's not a payment stablecoin, so therefore it technically falls outside of the scope. But we still built it to those standards. So I think that's a really good recommendation for anyone too operating outside of the United States, looking to whether they're issuing a stablecoin or they're working with a stablecoin issuer that's not U.S. based. Do their standards align with the Genius Act, right? Because that's going to also have scope creep within itself. And then eventually you're going to want to come in and potentially operate in the United States, which is what we saw with even just exchanges, right? Crypto exchanges that were outside the U.S., but the market, the attraction to the U.S. market is just so big, you eventually want to come in and provide services here. There's still so many use cases. I was mentioning this to somebody else just yesterday. I'm headed to Rio after this, so I'm going to be in Brazil. So my fiance's, I've got his PixPay account, but just to get money into Brazil, into PixPay, like we still had to take, we took cash to a bank here in the United States that went into his account here that then got sent via like Remitly, that then got put into his bank there, that then got put into his PixPay account, right? Like it's still very disjointed. The entire cross-border payment system.
They're messed up in the U.S.
Yeah,
the stuff JP Morgan did to me is unbelievable.
Yeah. So there's still so many use cases, and I know a lot of institutions they're trying to solve for this. Institutions that are not banks, you've got so many fintechs that are solving for this, but still think about the role that banks are still, even though you may not be like leading the payment rails, you still have a role. Right? There's still an important role. And so that's why Carol's saying banks are going to have to you're going to have to find a way to interact, be interoperable with stablecoins in some way.
Well, and customers want to bank with their banks.
Yes.
They really do. There may be some corporate treasury stuff where, and again, I go back to the data I have from Tacit, half of the transactions went on outside of banking hours, outside of the Fed window. So half.
Yeah.
So you're going to find corporates chasing the clock all over the world, and they want transactions that are not happening when the bank is open. Yep. So that's another use case, right?
Yeah.
But at the end of the day, honestly, until it lands into a US dollar in a bank, that transaction is not done.
Yeah.
It's going to keep circling until it does that.
So here's a great question for you, Yaya, that came in from the audience. Is there a technology or framework where the stablecoin provider could turn off the privacy on the blockchain with proper service, i.e. like a seizure warrant? And I have an answer, but I want to hear your take on this.
Well, I mean, generally, yes, but I mean, this is getting into the nuance of like, well, how does privacy work? And it depends on what is the tool that is being used. But what I had described in terms of what is being built on Alio allows the issuer to have, again, to be able to see what's going on and to be able to freeze and to keep even the private, even though someone has gone in and they're using this privacy stablecoin so that they can no longer transact. So yes, there is that ability.
And there's also
if there have been yacht registries on chain, do you know how fast Russian yachts could have been seized at any point? Like in a second. It wouldn't have taken months to go find them. Would have known where they were instantly.
And there's also, there's other technologies too that are being built by other layer ones using like ZK snarks. And we won't get super technical, but essentially it allows for only the counterparties to that transaction to actually see the transaction. But at the same time, the layer one and other issuers, they can be permissioned in at a certain level, and then you can actually control the levels of permission so that if you're say a financial institution that's involved, you could have X level of permission and you could see certain aspects of that transaction, but then you may not be able to see other transactions. And then at the same time, you can also permission in law enforcement or regulators to a different way, kind of like how you were talking about at for signature, you guys, the regulators were able to see various aspects of those transactions.
When signature was closed, the regulators were able to see all of it.
Yeah.
On chain.
Yeah. So let's look at some other questions that we have coming in. You guys have a lot of questions. I'm not going to get to them all, so I'm going to apologize. But feel free to hound Yaya and Carol after the panel.
Right.
They welcome it. Yaya doesn't really want to go work on a white paper. He really wants to talk to you guys. It says here, so this is really kind of an interesting question. If and when governments around the world, including the United States, decide to issue and implement CBDCs, would stablecoins and other digital coins go away or get dismissed? Well, my answer is always no. But
I think the reverse is happening. Although I mean, I should explain that. The reverse is happening in that if you were tracking CBDCs, so I've been doing a lot of research on CBDCs. At least I was the past 5 years, and the momentum was towards CBDCs. Like nobody was thinking about stablecoins, and lo and behold, whoop, things just flipped. Where much of the CBDC research and momentum has stalled and stopped because of what has happened in the United States with Genius and stablecoins. So it has been flipped. But I will say, there's just one thing just to put out there for people. It is important to watch what's happening because we haven't talked about the geopolitical stuff happening all around the world. I mean, I just saw an article just the other day which was saying that there's discussions between Iran, I mean, you can check to see how accurate it is, but between Iran and China trying to ensure that trading in oil happens in the yuan. Right? So obviously those are conversations that are happening geopolitically. The thing to know about that is if that is going to happen, well, how will it be traded? You should know China has been working for several years with some other countries for platforms to do CBDC to CBDC trading. So all of that infrastructure is already being built by software. That's why it's going to be important to track this.
And not just China. So the last 18 months when I was at Tacit, I was all over the world. Zurich, London, Abu Dhabi, Asia. The rest of the world is up and running. We are not.
Yeah.
And
catch up.
that's one of the things banks really need to understand is that there is a pause being taken because there is a preference for US dollar settlement. There really is.
Right.
But until last summer, it wasn't clear the US was going to step in and participate. It is, and it is now, but not before the contemplation of what would be our default currency if it's not the dollar.
Yeah. And the EU is taking a different course. The EU is right now saying that they want to do a CBDC. They've been looking at the stablecoins and they're like, not for us, and we don't want the US. So they're going in that direction. So you have to understand all of this.
Yeah.
Well, and you kind of have Circle to thank for that, by the way. They have been the leaders of going out to all corners of the world and helping them develop a regulatory framework. Hats off to Dante Disparte, for sure.
They've been very busy, that's for sure.
They've been busy.
So we have a question about if, USDT, Tether, USDC are backed by the same fiat currency, right, which is dollar. USDC, we also have USD, they have the euro as well, but does that turn them into like a high risk or a highly volatile coin? And I think the reason why I wanted to ask this question also too is it brings up a good point about how banks are going to treat stable coins, right? And how they can treat them on their balance sheet, which really makes a big difference. So for payment stables, there are different rules than, like, say, the one that I just brought up, which was the Marshall Islands, which is essentially a digital Brady bond. That actually can be treated as a high-quality liquid asset on a balance sheet. So there's different rules for how banks can actually treat and consider stable coins.
Since there has to be a one-to-one match,
Yeah.
banks, in my experience, have established omnibus accounts where they put that reserve.
Yeah.
And it's matched one-to-one.
And they just match it.
I don't believe that stable coins provide a volatility risk
Yeah.
at all.
I
Now,
agree.
if you want to lend on Bitcoin, you get
That's
a
totally
whole other math problem.
It's like, I like it when people are always like, oh, we talk about, business is booming I think for all three of us, right? We're really busy right now. And people are like, oh, but it's crypto winter. And I was like, crypto winter applies to Bitcoin and Ethereum. It doesn't apply to stable coins. If anything, we've seen doubling of the market capitalization and the value that's in circulation for stable coins almost every 6 months, 9 months. We're just seeing that market grow.
And can I mention something to take home with you? Someone in the US government, it doesn't matter who, but someone in the US government was telling me, they said that stablecoin issuers right now are the largest sort of single industry holder of US short-term treasuries.
Yes.
Yeah.
And the lesson they were trying to get forward with me was that we do not want this to go bad. They actually want stablecoins to be okay, because if that goes bad, it's not good for US treasuries, and that would be a bigger crisis.
I think that's such a good point. It's like now stablecoins are too big to fail.
Yeah.
Right? So that's kind of
That's not really a good analogy.
That's not a good analogy. No, but
Do we
that's
want to
where
end
we
on
are.
that? But I
That's
guess
where
we will.
are.
It's
Yeah.
a page turner.
That's where we are. So
Cliffhanger.
we are going to have to end on that. But like I said, come hunt them down. They'll be around. I didn't get to all of your questions, but I think, as you guys can see, this is a very relevant topic. Everyone in some way is going to be engaged. Next year, we're going to sit on the stage in the same panel, and everybody's hand's going to go up. So, so thank you guys. Thank you to my guests, and have a great rest of the conference.
All right.